The US government has created an artificial shortage of homes, thereby rigging the housing market and creating arguably the biggest housing bubble of all time in 2022. The government has accomplished this feat over the last 2 years during the pandemic by banning foreclosures, banning evictions, and then making it much easier for wealthy people to buy second homes and investment properties. The combination of these factors has robbed the housing market of inventory, creating the lowest active listing figure we've ever seen in the US housing market here in the spring of 2022, while also causing home prices adjusted for inflation to surge to all-time highs, even higher than they were in the 2006 housing bubble. It's important for all of you to remember that this is an artificial shortage. There is no true fundamental shortage of homes in America, because after all, there are 142 million housing units in America in 2022, according to the US Census Bureau. Roughly 95 million of those are single-family homes, while 47 million of those are condos and apartments. That's a lot of housing units, and in fact, America has more homes and apartments than it ever has relative to the size of the population and the employment base. As I just mentioned, there's 142 million housing units in America compared to an overall population of 332 million. That means that today there's 2.4 people in America for every one housing unit. That's actually the lowest level of people per housing unit that America has ever experienced in its history. In addition, there's been tremendous consistency across the last 5 decades in how many jobs there are in America for how many housing units there are. That's a ratio of 1.1 jobs for every one housing unit. You can see that this is actually below the long-term average, meaning that we have fewer employed people in America today relative to our housing stock. And I want to be clear to you all about what this means. It's that there is no fundamental shortage of homes in America. We have more than enough housing units in America in 2022 to satisfy the amount of people in this country as well as the amount of people who are employed in this country. This fundamental data comes in stark contrast to the conventional narrative of the housing market, which assumes that there is a massive shortage of homes. A study from the National Association of Realtors says that we have underbuilt by about 5 million homes over the last several decades, and that we're going to be in a perpetual shortage into the future. However, this study, as well as many of the other narratives talking about a shortage of homes, is basically propaganda produced by housing market advocates who want to FOMO people into buying homes at today's ridiculous prices. Instead, what these narratives should be talking about is not that there's a fundamental shortage of homes, which we know is not true based on the data on employment and population. Rather, it's that there's an artificial shortage of homes on the market created by the US government. During the pandemic, both the Trump and Biden administrations, as well as Jerome Powell and the Federal Reserve, teamed up to basically rig the housing market and make it so you can't find a home to buy or an apartment to rent. And this all started in March 2020 when the Trump administration enacted a foreclosure moratorium banning banks around America who use Fannie Mae and Freddie Mac-backed mortgages from foreclosing on borrowers. This foreclosure ban, while well-intentioned at first during the pandemic to keep people in their homes, lasted for far too long, and it basically only expired at the beginning of 2022 because the Biden administration kept extending it. The result is that there was fewer than 400,000 foreclosures in America in 2020 and 2021. That was a massive 70% decline from the 1.1 million foreclosures that took place in 2018 and 2019, meaning that 700,000 fewer foreclosures have taken place since the pandemic started than normal. Just how big an impact has this had on the housing market in terms of robbing inventory and pushing prices up? Well, take a look at this. According to Realtor.com, there's only 380,000 homes on the market right now in spring of 2022. If we had added back the 700,000 foreclosures that didn't happen, that would have gotten us 80% of the way back to the pre-pandemic norm of 1.3 million homes on the market. So the foreclosure ban in and of itself explains most of the reduction of inventory on the US housing market you're seeing today. But that's not all, folks. The US government also enacted an eviction moratorium in September of 2020 during the pandemic. Once again, it was the Trump administration and the Trump-run CDC that enacted this eviction moratorium in September of 2020, and then the Biden administration extended it and extended it and extended it, and it took the Supreme Court to strike it down in the fall of 2021. This eviction moratorium, which again was well-intentioned at its outset to prevent people from getting pushed out of their homes during the pandemic, has now had the unintended side effect of robbing the rental market in America of needed inventory. According to Eviction Lab, an organization that tracks evictions across America, they estimate that over 3 million eviction cases have been avoided nationwide between the start of the pandemic and the end of 2021. And while a lot of politicians and pundits are celebrating the fact that 3 million fewer people were evicted during the pandemic, that of course comes at a big cost and consequence. It means there's not as many units available for rent, which of course is a contributing factor to the record high rent growth we've seen in America, 15% year over year in 2021 and entering 2022. And this is especially relevant when you consider the fact that there's 44 million renter households in America, and these 3 million prevented eviction cases account for about 7% of the entire rental housing stock in America. So if we had some of these evictions go through, it's very likely there would have been much more inventory coming to the rental market. Maybe some of these people who got evicted would have had to move in with friends or family. That's the cost and consequence of not being able to fulfill your obligation of paying rent. The upside to this would have been a more balanced rental market where everyone else who was paying their rent wasn't facing a 10 to 20% increase. So between these two government policies during the pandemic, the foreclosure moratorium and the eviction moratorium, you can see how the government unintentionally, or maybe intentionally according to some people, created an artificial shortage of housing, which explains a majority of the craziness that we're seeing in both the for sale and the rental markets in America right now. Now, the good news is that both the foreclosure and the eviction moratorium has expired, so the housing market can start to go back to normal, but this is going to take some time, and I'm going to tell you at the end of the video when we can expect to see more inventory hitting the market from these foreclosures and evictions. But before we get into that, we need to talk about what the Federal Reserve and Jerome Powell did in 2021 and 2022. In response to the economic shock due to the pandemic, the Federal Reserve lowered the short-term interest rate to 0%. They bought a whole bunch of government bonds and mortgage-backed securities, and as a result, artificially suppressed both short-term and long-term interest rates. This in and of itself caused asset prices to boom both in the housing market and the stock market, and as a result there was a tremendous increase in something called the wealth effect in America, especially among high-income households. People felt a lot richer at the higher end of the income spectrum, and that combined with artificially low mortgage rates led to lots of households buying second and third homes. Data from Redfin shows that demand for second and third homes in America was up 80 to 90% from pre-pandemic levels, largely as a result of this wealth effect, these low mortgage rates, as well as the lockdowns in many cities across America that push people to buy homes in more suburban and rural locations. When someone decides to buy a second home, this is something that legitimately could lower housing inventory, because even though the population and employment levels for today's 142 million housing units are within their long-term norm, if all of a sudden more existing owners start buying second and third homes, that could deplete the inventory and push prices up, which is exactly what happened over the last 2 years. In addition, this low interest rate environment combined with the restriction in the rental market from the eviction moratorium, which pushed rents up, incentivized a lot of investors to buy into the market, both small and large. Data from CoreLogic shows that in 2019 and 2020, about 830,000 homes in America were purchased by an investor. But then in 2021, that figure shot up to over 1.4 million investor purchased homes, an increase of 600,000 compared to pre-pandemic levels. And if investors are buying 600,000 more homes on the market than they used to, that means there's 600,000 fewer homes for normal home buyers to buy, which is another contributing factor to the record low inventories in the for sale market today. In fact, if we combine that 700,000 shortfall in foreclosures with the 600,000 increase in investor buying homes, we get 1.3 million, which explains pretty much all of the difference in today's inventory levels from pre-pandemic inventory levels. And so it's in this way that Jerome Powell and the Federal Reserve also created an artificial shortage and rigged the housing market by creating incentives that made it a lot easier for both second home buyers and investor buyers to buy into the market. But here's the twist, folks. All of this government support and regulation and intervention to the housing market, which was completely unprecedented over the last 2 years, is now going into reverse. The foreclosure moratorium officially ended in early 2022 after the Consumer Finance and Protection Bureau's regulations expired. As a result, we've seen a massive 132% increase in foreclosure filings in the first quarter of 2022 2022 compared to the first quarter of 2021. As you can see, these levels of foreclosure filings are still below pre-pandemic norms. However, they are trending up and they will continue to trend up over the course of 2022. And I expect by the end of the year, we're going to see more foreclosures being filed in America than we did in 2018 and 2019. These foreclosures, of course, are going to bring much needed inventory to the U.S. housing market. At the same time, evictions are starting to surge in many areas across the country. Austin, Texas, Minneapolis, Minnesota, and Hartford, Connecticut are just some cities where evictions are surging according to data from Eviction Lab. So in addition to more homes for sale through foreclosures, we're going to have more homes for rent hit the market due to increased eviction. At the same time, demand for second and third homes from wealthy home buyers has plummeted. The same data from Redfin that showed an 80 to 90% increase in second home buyer demand has shown a massive drop off in this red line over the last 3 months to now in March 2022, only 13% above pre-pandemic levels for demand for second and third homes. Fewer people buying second and third homes is going to mean more inventory on the market for the regular home buyer. And perhaps most interestingly, investor home buying also appears to be on the decline. Data from CoreLogic shows that single-family investor activity stalled in the fourth quarter of 2021, and in particular, there was a big drop-off in December in terms of investor home purchases as a share of total home purchases in America. Higher interest and mortgage rates are no doubt a primary reason why we're seeing fewer people opt to buy a second home or an investor home. And as the interest and mortgage rates continue to go up into the future, I believe we'll see this continued decline in second and investor home demand. And now that all these government programs and incentives are going into reverse, you're going to see the housing market return to a more normal level. And in fact, I think there's going to go from being an artificial shortage to an artificial oversupply of housing as those backlogs of evictions and foreclosures hit the market and as many investors and second home buyers actually begin to sell. Oh yeah, and don't forget, on top of all of this, there are 1.6 million homes actively under construction on the market right now, according to the U.S. Census Bureau, which are going to be delivering over the next 6 to 12 months. Now, one final thing I'm going to leave you with in this video is an additional data point on the long-term demographics for the housing market and why they look terrible, everyone. That's because we are seeing a dramatic reduction in prime age home buyers in America. Today, there are 42 million households in America, people who occupy housing units between the ages of 25 and 44, roughly that millennial age segment. What you can notice on this graph is that over the last 30 years, there's been a complete stagnation in the amount of housing units demanded by this prime age first-time homebuyer segment. This looks especially bad when you look at this millennial housing demand in comparison to the amount of housing units in America, which has gone up consistently over the last 30 years, which means that today only 30% of housing units in America are occupied by this prime age millennial homebuyer segment. In addition, the amount of households with children has experienced similar stagnation. You can see only 32 million households in America have a child. That's below the level of 30 years ago in nominal terms, and in percentage terms, it's by far the lowest level of all time. Only 23% of housing units in America are occupied by households with a child. This, of course, is very bad for the long-term fundamentals of the U.S. housing market because it suggests that this whole narrative about all these millennials who want to buy a home and start a family, it's not true. And in fact, the main segment of people supporting today's housing market are baby boomers and elderly people who live alone, along with, as I talked about before, second home buyers and investor buyers. I'm going to explain more about this demographic shift in the U.S. housing market next week and why it means that home values in America are going to be going down, not just in the short term, but in the long term. So if you want to see that, make sure you're a subscriber to this channel, have your subscribe notifications turned on. Also make sure to smash that like button so you can support this video and get it out to more people. There was a lot of data presented in this video, so I took the liberty of putting together a Google Sheet with a lot of the underlying data as well as links to all of the articles I showed you in this video. The link is in the description. I would encourage you all to check out the data for yourself and then go rewatch the video so you understand it better a second time around.